All right. Good afternoon, everyone, and welcome. So today we are going to do our webinar on how to master the #1 options income strategy. This is by far one of the most common strategies that's utilized by options traders, and that's mainly through volume that you see within the exchange, as well as more of a longer term strategy. And we're going to go through that, go through a lot of the best practices and items of that nature. So thank you for joining today with this first trade event, and we're excited to dive right into this. So I may be a new face, so I do want to take a moment just to introduce myself. My name is Jessica Inskip, and I'm the newest director of education and product for Options Play. I've been in the industry since 2009, so a little over 13 years, worked in a lot of various firms and different roles, from product management to strategic prioritization. A lot of compliance and risk is really a lot where my background comes from. But I've been in the background a lot for brokerage firms. So I've had a lot of education that I would provide, but it was always to the frontline representatives. So anybody who would answer the phone and answer questions and details like that. Or I'd also talk directly to FINRA, members on the exchange and things like that as well. So there's a lot that I've done in the background. And so now we're just bringing that forward as I joined Options Play. So I'm really excited to do that and to share a lot of the educational experiences that I've had over time. So thank you for joining today, and lovely to meet everyone. So before we dive in, let me start with a very important disclaimer. So first and foremost, Options Play is a third party not affiliated with First Trade. So any opinions, commentary is purely that of Options Play. You should always seek talk to an investment advisor and look at your investment objective when making those type of decisions. As far as Options Play is concerned, types of securities, forms, and research tools used in this video and webinar are purely for demonstration purposes only, should not be considered a recommendation by Options Play or a solicitation or an offer to buy or sell any securities. This video is not intended to be used for individual tax, legal, or investment planning advice. All examples are for illustration purposes only, and all examples do not include any commissions or fees. All right, so let's dive in. So here's what we're going to cover today. We're actually going to start with a view of growth versus income and really dive into that and where we can talk about the middle ground. So we'll actually start with looking and analyzing securities, stocks, and ETFs. And we'll answer that question: what is a covered call? That most commonly used income strategy. That's the strategy that it is, a covered call. So we're going to dive really deep into that, make sure that we understand it fully. Of course, there's going to be lots of examples throughout. We'll go through optimal cover calls, what to look for, things of that nature, tools and resources that are available. We'll also go through an opportunity report. I will show you how to find that on First Trade's platform. And I'll also go through some trading tips that Options Play has come up with through tons of back testing and data that really helps create that optimal experience for covered calls. So we'll go into detail. But the primary question that we want to answer today is, how can I generate a consistent additional yield on a portfolio utilizing options? So that's what I want you to get out of today. So let's start with growth versus income. So it's something you probably heard before, but there are actually 3 categories of stocks that you find or that you learn about. Growth and income and value is the third, but we're going to talk about growth and income today for the purposes of this option strategy. So for growth stocks, you're buying a security, you're generally looking for upward momentum. With growth, that's accelerated. The way that you can see that is they have sometimes higher betas, so they move more quickly, a higher PE ratio relative to their benchmark. They generally do not pay dividends. That's because the company, whenever they have earnings or profits, they will take those profits, and instead of sharing them with the shareholders in the form of a dividend, they'll reinvest them back into the company, hoping for that accelerated growth. So growth securities are for the investor seeking capital appreciation. A really great example of that is Amazon. It's a growth stock, moves quite a bit. That is a great example. Income, on the other hand, has a lower price to earnings ratio. So doesn't move as much. You're not expecting accelerated growth, but we're looking for income. They do pay dividends. So any of the profits or earnings that the company receives, they will take a portion of that and provide it to the shareholder in the form of a dividend. So these tend to be more sideways or less capital appreciation is expected with these type of securities. So this is for the investor seeking investment income. AT&T is a great example of an income security, or utility stocks, so a sector that tends to be a little bit of a safe haven or rather stable or things of that nature that pay a dividend. Those are great examples of those type of things. So now, why am I telling you this? When you are investing in a covered call strategy, it's actually the hybrid in between the two. We want capital appreciation when you're buying the security. If you're buying a stock is a component of a covered call. You absolutely want the security to go up in value. So that's a piece of it. And then we're going to add the income component to it with the covered call, and we'll go deeper into that in just a moment. So that's really the purpose of showing you this, and to talk about growth versus income is what you're looking for as a stock investor and how you can complement that with covered calls. We can take a growth security and optimally choose strike prices and expirations for a covered call in order to add income for a security that doesn't necessarily have a dividend, or if we have a security that does have a dividend and purely is for the income seeking investor, we can enhance that dividend and optimize the yield with covered calls. So it's really a strategy that you can implement with various types of securities. Securities don't necessarily just fall in either one of these categories. There are other categories. They can be a mix of the two, but this is just on a high level, growth versus income, what we can look at and how we can utilize that with covered calls to enhance either strategy. All right, so let's talk about what a covered call is. If you don't mind, if you want to just put in the chat, give me an answer here if anyone has traded a long call before. Just want to know if we need to cover that, or if you have traded a long call, just in the chat. You can just type in a Y. Thank you, Jonathan. Lots of yeses out there. Awesome, that's great. All right, so just a quick overview of a long call. When you purchase a long call, you purchase the right to buy a certain security at a certain price within a specified time frame, and you pay a premium in order to have that right. So it's essentially a contract. You are speculative. You, the long call holder, wants the stock to move above the strike as much as possible before the expiration date. Now, the short call holder is just on the other end of that. You are not speculative, so this is purely short without owning an underlying security. You want the shares to remain below the strike. So you may be neutral, you may be bearish, you are certainly not bullish purely with just a short call. And you have unlimited risk with the short call. It's the only option strategy, a naked call that has substantial unlimited risk. And that's because the long call holder has the right to buy those shares at any time, and they can theoretically go to an infinite price. Is that possible? Logical in the time frame? Sure, it can absolutely skyrocket, but that price is infinite, I suppose. Now, the short call holder is obligated to sell the shares to that long call holder when they choose. So I love to use the analogy, it's like driving in a car. If you have a long call, you are the driver. If you have a short call, you are the passenger. If you are the passenger, you may have some idea and some road signs to understand where you are going, but ultimately the driver is going to decide if you go left or right. So the driver is the one that the long call holder initiates the exercise, and they can say, I would like to buy those shares at this time. they are the ones in charge. The short call holder is obligated to sell those shares. And that can happen at any time without any notice. It's logical, and we can decide when that's going to happen. And I'll go over assignment risk at the very end to understand when that is, and how to make sure that you're very cognizant of that and have a great situation. But what I just want you to get from this is the short call holder is simply the other side of that. You are looking for it to expire worthless. You want to capture the premium. You keep that premium that the long call holder is paying. So now entering into a covered call, it's where instead of having that naked risk, where if the underlying security goes to an infinite price, you are going to have to sell it to that long call holder who wants to execute on that contract. You don't know what price that may be, and that's why it's unlimited risk. You could have a strike of 100, and all of a sudden it's $500, and you're out a ton of money if it went up 400. So the idea of a covered call will give you something to cover that risk. So if you are obligated to sell your shares to that long call holder through the assignment process, you already own them at a specified price. So you're going to really limit the risk of a naked call. But now that we're adding the security, now you're going to have some type of objective associated with that, which is essentially, I want to have a growth view, so capital appreciation or income. That's where it is once we have the security, and adding the covered call to that security is how we're going to enhance that, and we'll talk about that. So in order to have a covered call, you have to have at least 100 shares of an optional stock or ETF. Contracts trade in increments of 100 normally, so it requires increments of 100 in order to have the covered call. As soon as you sell that call, you are actually taking those securities that you own and you're utilizing them as collateral. And you are saying, I am agreeing to put up my shares, and I will sell you those shares at a specified price within this time frame. And within that time frame, your shares are now kept as collateral. And in exchange for that, you receive a premium. So that's the income that we're going to talk about a little more. And it does create that obligation for the specified price. So I do have the profit and loss chart here, and I want to talk about that for just one brief moment. So this line here represents the profit and loss purely for owning a security. So if I own a security, the max that I can lose is the purchase price for it. So if I spend $100 on Apple or ABC stock, whatever it is, the max I can lose is $100, but the max I can gain is technically unlimited because it can theoretically go to an infinite price. When you add the covered call, you're putting it up as collateral and you're actually capping that price. So that's where this line comes in. Your max gain, instead of being infinite, is actually capped at the strike price. And so it's important to choose price targets, and we'll go through that in a very brief moment. But that's an important component of it. As you're giving up collateral, you are agreeing to sell your shares at a specified price. So the goal of this class or webinar is to figure out what that specified price is and how to choose optimal strikes and expirations. So receiving that premium limits your upward potential, but it also really reduces the downside risk, because now, as you're putting up your securities for collateral, so if I sell something for $1 and I bought Apple at 100, well, I received $1. So now my downside risk moves from 100 to 99. And the key is just to do that over time so you can capitalize in various markets. So regardless of which direction your underlying security will go, you are constantly and consistently reducing the cost basis for that underlying security. That way it reduces your downside risk over time, and you're receiving a premium at the time. Now, I will say I explain covered calls by saying reducing cost basis. No, for tax purposes, it is very different and it does not act that way. And if there are questions on that, we can go over that later. All right, so let's move on. So now I've got a chart of Apple. We'll use this as an example. And let's look at this the eyes of the stock investor. So I'm a growth stock investor. I'm decided I want to purchase Apple for whatever reason that I am, for those analyst reports, so on and so forth. I'm going to go ahead and purchase it at the market at 168. Let's say that's where it is. When I purchase it at 168, I may say, I have a price target where these peaks are hitting at 180. And when you do that, you are just hoping for upward momentum, and you put a sell limit for a 180 for your 100 shares of Apple. Now, when you do that, and rules require this, and every brokerage firm is going to do this, you are putting up your shares as collateral. You are not allowed to put any other orders on that 100 shares of Apple, because you've specified your order on the market to sell at 180. You are making a commitment. You can cancel that at any time, but you're not receiving any income for that commitment. But it's your limit order for your exit strategy, whatever you've decided. And that exit strategy could be a variety of things. It could be analyst ratings. It could be via technical analysis. If you're really good, it's a combination of both. And we can go through that as well. But what I want you to get out of this is you are essentially putting a sell limit order and utilizing your stock as collateral when you are doing that. And you have a specified price target at that time. So for the stock investor, their max risk in this scenario is $168 a share, the purchase price of Apple. Logical. Their max reward is the difference of that limit order and the purchase price, so $12 per share. And their exposure is exposed to the downside entirely until Apple reaches 180. You're always exposed with any trade, really, but in this case, this security until you close it. So if you hold the shares, you're exposed until you sell them. During that time frame, you can possibly collect dividends while you're exposed. Let's look at this from the eyes of the stock and options investor. So same person, say you've attended this class and now has decided to implement this. We are buying 100 shares of Apple at 168, still have that same price target of 180, but instead of setting a limit order to sell at 180, we're going to sell a 30-day call, is what I'm going to put out there, at 180 and collect $1 premium. So at this time, there's still upward potential. So we're looking for that capital appreciation. The risk has actually been reduced by $1 from 168 to 167. The reward increased from 12 to 13 because we received that dollar. And now we're generating $1 a month while that call, if we consistently write that call, and potentially can collect dividends until Apple reaches our upwards price target. So there's two things that happened with either investor. First, the limit order investor is giving up upward potential. When you have a limit order to sell, if the bid hits your price, it's going to execute. You'll be due a fill. Those shares will be gone. If you cancel that limit order or replace it to a higher price or things of that nature, possibly a trailing stop, you can maneuver it around in various scenarios and adjust your price target. But there are generally expiration dates attached to your limit order. You can set them up for 90 days or 30 days or things like that. And there are with the contract. So now let's move back to the contract. With the contract, you are setting an expiration date and a specified price. You have an obligation, and for that obligation, you're receiving $1 a share. Now, there are differences with that, and we can talk a little deeper about that. But what I want you to understand is the covered call acts like a limit order. You keep that upward potential. You are still capping it because you are specifying an exit price, but reduces your risk and increases your reward. And a lot of investing, and a lot that we talk about at Options Play, is the risk to reward ratio. And this is a way to move this and optimize it in your favor. All right, so does that make sense? If it makes sense, just give me a yes or a no in that chat. That's an important part before we move in. Tons of yeses, that's good. All right. So let's talk about optimal cover calls. So now we understand that it's a price target. We are seeking capital appreciation. The way to really properly execute upon that, or the success of the strategy, is highly reliant on your selected strikes and expirations. And Options Play has done some back testing, so I'm not even gonna really go into the details of optimal expiration date. I can give you a little details of that, but just make it a little easy. The optimal expiration is 45 days based on the months and months and months and years of back testing that Options Play has done, has found that 45 days is the optimal expiration. Now, thinking about the strike that you would choose, I've laid 3 in front of you. So we're looking at Seagate Technology, and now we're gonna look at this from an income perspective. So Seagate's at 88.61. If I own Seagate, I can potentially get a dividend of 264 per share, and that yields me around 3%. So looking at the strikes in the covered call, so these are all 45 days out, but now we're just looking at different strike prices. So we've got a $100 strike price, so that's giving us our upward momentum to 100. That's going to collect $75 a share, excuse me, 75 cents a share, so $75 altogether. That's going to be a raw return of about 0.85%. So the raw return is literally the amount of the premium in comparison to the last price. Annualized, that's 7.14%. The 97.5 strike, so going a little lower, is going to give us a higher premium of $1.05. That raw return is 1.18%, annualized about 10. And the 95 is going to give us a $1.50 premium with a raw return of 169, annualized about 14.5. So just purely looking at this, I'd love for you to put this in the chat. Which one would you choose? So you know you've got STX. Are you going to choose the 100 strike, 97.5, or 95, purely on the information that I just gave you? See hundreds. 95, okay. 97.5. All right. Variety. All right. $105. I like that one. All right. So they are all great answers. Thank you. So let's talk about what those mean. And it's really your choice, and that's what it comes down to. But my job is to explain to you all of the surrounding circumstances around them, and what each strike price offers you, and how to choose the optimal one that really fits into your specific investment strategy. So the best way to look at this is a probability-based approach. So remember, when you are selling a call, regardless if you have it covered or offset by a long position of some sort, you are wanting to collect that premium. So that's why a lot of you, I noticed, put the 95, but there really was a variety. But you do want that premium, and you do want it to expire worthless. Now, if we add a stock, you still want capital appreciation. And so we do want to make sure that we account for that growth and we don't give up for it. So there's certainly a mix for it. And yes, we don't necessarily want the stock to be called away. So there's ways to think about that. So with that probability approach, a Greek to look at is delta. So I've laid out the deltas here. The 100 has a 15 delta, the 97.5 a 25, the 95 to 30. So and one thing I did forget to mention, the closer the strike is to the underlying, the more expensive it's going to be. So that's something we saw here. Delta also tells us that, and the probability of expiring in the money. So something that's at the money is going to have a 50 delta. So if we had something at 88.50, that's going to be a 0.5 delta or a 50 delta because it's got a 50% chance of being in the money. It's going to go up or down, right? It's either, it's that simple. So now moving out, if something has a 15 delta, that means it's got a 15% chance of expiring in the money, which is what we do not want as the short call writer. That means it actually has an 85% chance, so just the difference there, of expiring worthless. And so the lower the delta, the higher your probability of expiring worthless. And that's an important component to know if you are not wanting the stock to be called away and you're looking to maximize that income. Now that's the income component, let's talk about growth and capital appreciation. If I choose this 95 delta, yes, or excuse me, 95 strike, 30 delta, I am going to collect the most premium off of this. However, I am going to give up a lot, $5 of upward potential, really. So in all reality, this is going to yield us the most because it's going to give us 75 cents of income, but it's also going to give us from the 95 an additional $5 per share of upward momentum. So that capital appreciation is something that's important. When you're looking purely at really any short option, but we utilize a short call here, you may look for something that's going to capitalize and create the most premium. But when you add a stock, your stock is the soul and heart of this strategy. There is capital appreciation associated with it. So therefore, that's when price targets are extremely important, and you can utilize delta to define the probability of expiring worthless to find those optimal expirations and strike prices. All right. And normally I hold Q&A into the end, but I do want to pause there. Are there any questions on that? You can just put them into the chat or the Q&A. I'm happy to answer either. All right. What is the optimal delta? That is a good question, Peter. So options will say that the lower delta is the optimal delta. So 0.1 to 0.2. So I will split the spread and say 0.15, which is here. So 15 delta. That's the optimal with a 45-day expiration. Remember that that's something that we specified up front. Once you start mixing expirations around, then you may have a different answer. But the optimal for a covered call, this is ensuring that you have that capital appreciation. You are looking for a 0.15 delta or 15 delta, 10, 20 delta, around that area. Should you aim for 1% of the stock price as your premium? That's relatively aggressive, or not necessarily so. I would look at the premium. I would look more at the way the option is pricing versus a percentage of the stock versus the premium, if that makes sense. So you can use other Greeks with that as well, but I think delta would be the good one for that. I wouldn't necessarily look for an optimal percentage, because then what would happen is you'll end up getting really deltas, and then you're going to get your stock called away relatively quickly. All right, delta calculated based on technicals. It is not. Black-Scholes model. All right, okay, so I'm going to move on, and we'll take more questions on the end. I just wanted to make sure that that was clearly articulated. I think that was a pretty important one. All right, So as far as looking for optimal covered calls, so what's great at Options Play is that's our mission, is we want to make sure that we provide investors with all of the tools and resources that they need in order to trade options successfully and responsibly and grow your account. So one of those is the covered call report. At First Trade, you've got the credit spread report, the covered call report, and the short put report. So literally everything. You can find that on the First Trade site by going to Research and Tools, Options, and then you'll land on something that looks like this, and then you'll click on the covered call report. This is where optimal covered calls are coming into play, and securities will also be here. So if you're trying to find a stock, you can certainly look here as a starting point. You can also utilize screeners and curated lists as well. Or if you already have a security and are looking for an optimal covered call, you could use the options wizard, or you can come into the covered call report, do a Control-F and find your security. This is something that's updated on an hourly basis. So let me show you some of the tools that are here, but the intent of this report or this screen is to find optimal covered calls and do the heavy lifting for you. So that methodology that we have in analyzing for Delta and a few of the other Greeks is actually implemented here. And that's taking into account capital appreciation and the most income. On First Trade, you'll find that it's sorted alphabetically. For optimal opportunities, you can look for the highest yield and sort by raw return or annualized return. So you can just click on either one of those. One of the tips that we'll go into is raw return and start with that, which I've done here. Now there's some information that you will find here as well. So I think I saw a question go in with IV. Yes, IV rank, what's this one? I mean, I personally love to use every single Greek altogether, but for covered calls, I don't think that's necessary in the slightest. However, on this report, you can use IV rank, which will give you an idea of how volatile it's been in comparison to what it has since IV, each individual security kind of has their own IV. So you look at it relative to itself and its sector, not necessarily each other. And IV rank blurs, takes the noise out and makes it a little more clear. Nonetheless, on this report, you'll see the expiration date, the symbols, strike price. There is an earnings flag and an earnings date. So that's something important to be cognizant of. When you are selling a covered call, yes, you want that capital appreciation, but if you have something like earnings, that's going to give you a spiked IV or a higher premium, yes, but the likelihood of the underlying security blowing through your strike is now much higher because earnings is there and the likelihood of you being called away. So that's really a personal decision. Do you want to participate in earnings while having a covered call? If you do, know you are capping your upward potential. Then your raw return, we discussed that. That's the return that you'll receive from that premium purely on an annualized basis, and then distance to strike. So this is something that we didn't talk about. That's that upward momentum. So just the difference between the strike price and the stock price. That's the difference in the capital appreciation that you could potentially expect. And remember that the key to this isn't you're not going to sell one covered call. You're going to do it out 8.5 times a year. If you take 365 divided by 45, I believe that's what it is. 8.18. Therefore, you're going to do that often. That's the important thing. It's trade small, trade often. You're going to constantly create income off of that security, and you're going to adjust that price target as the security moves and utilize other factors to determine what that is. But at Options Play, we want to make sure that we help you with that. So these are updated on an hourly basis. You can go into the site and find a security, and then when you're rolling or looking for an optimal covered call, it's there for you. First Trade, make sure the tools are there for you. All right. So we do have some tips for finding yields. So the first is focus on stocks that you're familiar with and comfortable investing in. It's actually the first thing I feel like I learned over a decade ago. So whenever you're purchasing any security, you want to know it, especially if it's something that you haven't done for a while. Don't go on that report and just randomly choose a security. Remember, the heart of a covered call strategy is growth or income or value, because you have a security involved. You have a stock or an ETF involved. So you want to make sure that you're familiar with that stock and ETF. And there's lots of tools and resources to look at them, and First Trade has that right on their research page. So make sure you check that out and are very familiar with the security that you want to sell the covered call on. That's important step number one. Number two is high yielding income portfolios sort by raw return. So we talked about that in the report that's there. This is where you can just click on raw return and then it'll sort it by the highest. That will optimize the highest income from that report that's there. So that's the tip for looking for higher income. It's already sorted with optimal strike prices and expirations. Now you're looking for ideas. This is the way you can look with yields. Small accounts aren't, you can sort by stock price and focus on lower price securities. So that is something I've heard quite often, is the wheel strategy or covered call writing is only intended for really large accounts. And that's not necessarily true. It's intended for people who want to purchase securities. And there are a variety of prices within securities. And that's why on that report, you can simply sort by stock price, or you have screeners where you can filter for that type of thing. You do have to own at least 100 shares, but if you have a small account, you can filter by stock price in order to find a starting point. And earnings, we talked about that briefly as well. But that is something very important with options. And that's when you dive deeper into implied volatility, which we are definitely going to do more sessions on and dive deeper into the Greeks and what exactly that means. But implied volatility is a pricing component of options. And we'll talk about that for a brief moment. The textbook definition of implied volatility is the market's forecast of a likely movement in the underlying security. And what that means is, if there's earnings is a really, really great example of that. We expect a movement of the security to move up or down in either direction. And analysts are going to have a specific expectation. And if it exceeds or goes below, there's going to be a rally or a drop. We know that happens with earnings because there is a higher likelihood of the underlying being above or below your strike. The premium is going to be more expensive, but then it may crush. That's called volatility crush, where as soon as the market releases the news or the earnings, it immediately just disintegrates the premium, and that's called volatility crush, and something we can talk definitely more detail on. I think that's an hour-long conversation, but definitely a fun one. But that's something to be cognizant of whenever trading options. But for covered calls, you're giving up upward potential, and the likelihood of being called away is relatively high. All right, so let's talk about some scenarios and what you should do in these scenarios, or what your options are. So looking back at Seagate Technology, you've written your covered call. Let's say it's around 100 here, and it rallies. So this is something where if it rallies just to $100 or your strike price, we're happy. We've done exactly what you wanted. That's the optimal situation. You are going to expire right at the money, so there's no being called away. That's great. However, if it rallies beyond your strike price, there are a few things that can happen. So I've seen a lot of people get really panic, and they freak out because they'll log into their account and you'll see an individual short call with a massive loss. And that's not necessarily true, because you have to take into account the underlying security because you have a covered call. But it really depends on the time frame. So going back to options pricing, when this happens, remember that a component of options pricing is time till expiration. The more time you have until expiration, the more expensive the option is going to be. But that time is a decaying factor. So as time goes on, that's going to be removed. And for the short call holder, that benefits us. It's great. We want time to go by. We want that premium to go less, 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 less. That way you can buy it back at a lower price or it expires worthless. So time is something that works in our favor as we are selling covered calls. So when the underlying blows through our strike price was really high above that, a question you need to ask yourself is how much time is priced into this option? How much time is left on this option. So the way theta decay works, or time decay, it's like a cliff. So it starts with its farther date expiration. It's very, very slow, but as it gets close to the end of the life of that option, it goes off of a cliff. So that time value really starts rapidly going away until it hits zero, because options are only worth their intrinsic value on expiration. That has to deplete, and it depletes really quickly. That happens around 1 to 2 weeks. So that's why we have this here for this scenario, is holding a position and consider rolling it. So you could roll it up to a higher strike price if you want to own that security still. There's lots of things you can do in that scenario. But if it goes through your strike price, and you may want to consider just holding that position, the theta decay will come down and reduce that loss that you've experienced, or you can roll it to a higher strike price. So now rolling too early will lock in a loss. That's very true, and that's because of the theta decay. So if you don't wait until that 1 to 2 weeks, until that time has started depleting rapidly, that is naturally and organically going to happen with an option. So if you freak out immediately and you say, "Oh, it's gone through my upper limit, I'm going to go ahead and roll now," well, that it's possible that it could have moved lower. It also could have moved higher. But what will happen is time will decay, and that's something that's important within that scenario to consider. And third, last, certainly not least within this scenario, be happy if your stock called away. The optimal covered call strategy is capital appreciation. So just like that limit order, you are saying, I'm comfortable selling my shares at this price. And if you are, it hits your price. It means you made a profit either way in all of these scenarios. All right. Let's talk about it trading sideways. So we have our strike of 100, doesn't necessarily go anywhere, sitting there, the end. Well, you can hold your position. And again, that's that theta decay. You want to capitalize on theta decay. If it has not hit your strike price, which is your upwards limit, there's no reason to really do much with that option. Just depends on what you want to happen in your outlook. One of our best tips here is roll it once you've made 75% of your max reward. So if you sold it for, I lost my train of thought there. Nonetheless, hold the position and you can roll it once you made 75% of it. So go ahead and do that. And there's no harm in holding the call until expiration, because it's going to expire worthless. And that's something that's super important. Back to the 75% of max reward, that's to account for liquidity. So if you have the option and you are going to hold it all the way till expiration, if it is sideways and doesn't meet your strike price, that means it's out of the money. That 75% of max reward is to ensure that you have liquidity. So when an option is out of the money, especially at expiration, there are going to be really wide spreads, and it's going to be very difficult for you to exit that position. It'll end up expiring worthless if you can't get out of it, because it's going to be very difficult to close it. But that 75% of max reward protects that ability to close out the option and roll it up or down, whichever way you feel the security is going to be. If you do end up holding it till expiration, something that's extremely important, and remember, the best way to create that optimal income experience is to sell another covered call that following Monday. So we're assuming this expired on Friday. Don't forget to go in on Monday, look through that report, and go through your process and sell another call that Monday. All right. All right, so stocks declining. This is maybe our not necessarily our worst case scenario. Neither of these are, because remember the downside risk is what you have with the security and selling the covered call and collecting that premium reduces that downside risk. And that's something that does happen in all three of these scenarios. But if the stock does decline much lower than where you purchased the stock at, and of course below the strike, so it's down here, you may want to roll down your covered call early, because at that point, you would be able to. And again, it's that liquidity. Things move around. You want to make sure that there is a market for it, and you need to be able to buy to close that option and sell another. So that's all roll means. It's just a fancy way of saying buying back what I sold and selling another. We say to buy that back at 20% of the original premium. So if you've sold it for $100, then $20 or 20 cents per share. So you put in that order for 20 cents. Don't let those go to expiration. Lock in the gain, because at that point, you do want it to expire. Individually, a short call is a bearish position, and you'll be able to capitalize that premium that you've received. So lock it in just in case there is more movement or upward movement or things like that. You can get more premium at that time because you've hit an optimal level. And then ask yourself if you do want to be invested in this security. If it's not moving the way that you thought, are you still bullish in that stock? Because remember, you're owning a stock and the ultimate goal is capital appreciation. Covered calls just simply help you add income to that. All right. So now let's talk about some of the additional risks. This one I actually took screenshots a little earlier today, but one of those is early assignment. Anytime you have a short call specifically, there is early assignment risk due to an ex dividend. So now let's go back to the long call holder, the person you sold this right to buy the stock at, and you're obligated to sell it to them. They have the right to buy that stock, and they may want a dividend. And since they're the driver, they could do a little calculation and say, it's going to make more sense for me to exercise my rights and get this dividend, causing you to be assigned early. And that's something to be very cognizant of. It's easy to be cognizant of. You just got to know if the security that you hold has an ex-dividend date coming up. The stockholder is required to own the security the day before the ex-dividend date. So the day to really take this into account is the day before the ex-dividend. This is a screenshot of First Trade's platform. You can just click on detailed quote and you'll see that information there. So that's important to know, but you can see when the ex-dividend date is. So I pulled up Alcoa. This is applicable today. So if you hold Alcoa and you have a short call, covered or not, just a short call, this is something you need to look at. Every single one of these are probably going to be exercised, and let me tell you why. So the number that I have here next to the calls is their in the money value. So if I have the right to buy at $49.50, Altria is trading at $53.26, that's $3.76 worth of intrinsic value. Well, if you look between the bid and ask, it's definitely trading at intrinsic value. These are the ones expiring tomorrow. However, if I can exercise my rights and buy 100 shares and entitle myself to this 90-cent dividend, 376 plus 90 is more than this. Therefore, it makes more sense for me as the long call holder to exercise my shares if I have the funds and get that dividend. So that's the important thing here. So now I, as a short call holder, have to fully be aware of that, because I may be assigned early, in which case the only way to mitigate not being assigned is to not have a short option. So you have to close it or roll it out to something that doesn't have intrinsic value plus the dividend priced into it, something that makes more sense. And that's true with assignment in general. That's the calculation that you do to figure out if you're going to be assigned. If the bid and ask is equivalent to the intrinsic value and there's nothing else there, well, just think of it in the eyes of the long call holder. That's the easiest way to do it. If I am the person owning the long call, does it make sense for me to exercise those? from a financial logical perspective, if the answer is yes, then you are most likely going to get assigned. So in this scenario, anybody who has these securities are probably going to get assigned because every single one of these, pricing intrinsic value plus 90 cents, the midpoint or even the bid is less than that. Therefore, they will be assigned. So that's important to know. And then the third, or excuse me, second risk here, and this one is applicable to all short options, not just calls. So short calls, dividend risk is only applicable there. I would call this one surprise assignment, and it's something that's come up a little more frequently due to the volatility in the market, but something to be incredibly aware of. And I've thrown an actual example up here as well. And so this happens when your option is expiring very close to the money. So as someone who is a options premium seller, you may log in on that Friday and have something that's very, very close to the money, but it doesn't necessarily get there at 4 p.m. And you're like, all right, good to go. It's expiring, worthless. That is true. However, the OCC accepts exercise instructions until 5:30 p.m. Eastern time, which means that the long call holder who's on the other side of that may say, oh man, didn't make any money. I'm at my max loss. It's nothing I can do. Then some tweet comes out, some news, you name it, and post market before 5:30, that underlying security just skyrockets. Well, that option has stopped trading, so the long call holder cannot sell it to close. The only thing they can do to capitalize is exercise. And they can do that because the OCC says we'll accept instructions until 5:30 p.m. Eastern time. So when that happens, the person who is the short call holder, they are normally randomly assigned, or FIFO, whichever the brokerage firm accepts, and not notified until the following Monday. And that's what I call surprise assignment. And that's something where you just have to be really cognizant of those securities that have a high beta or really fluctuate a lot. And because that's the only way that the long call holder can capitalize on it. And so if you're looking at your risk of assignment, the best way to do it is to look at the person on the other side of the trade, put yourself in their shoes and what would they do, and that'll give you an idea. So here's an actual example of Tesla. I'm working at a different brokerage firm and it became a big headache for everyone because this happened on this day. But if you were hold a short Tesla 1060 call, and this also, like I said, could happen on the inverse on the flip side. But Tesla closed at the end of the year, 1056, something happened post-market and it went really, 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 really high. If you had that short option at 1056, you know you were really close, but you thought you made your maximum profit, which you technically did because the market closed. But something happened to Tesla and it jumped really, really high before 5:30 p.m. Eastern time. Therefore, you got your surprise assignment. Maybe you went off and did your happy hour for the day or whatever happened that day. Nonetheless, the only way that long call holder could capitalize is by submitting those exercise instructions, resulting in your subsequent assignment. So the lesson for that is there's always assignment risk if you have a short option, period. The only way to mitigate that is to close your options. And that's why that rule is there in the various scenarios. So if it's 75% or that 20%, that's the intention of those rules, is to try your best not to hold until expiration because of that reason. All right. That puts us right to the end of the presentation. So I'll go ahead and take some questions if we have any more. There is one that came earlier about the wheel strategy. I know we're going to do a presentation on that at sometime in the future. But yeah, that technically can work in any type of environment, bear, neutral, or bull, because you're capitalizing on premium. So if you're selling that put, you may not get assigned, and so it's just waiting on that. What is the best ET to buy? Don't understand that question. Please retype that one for me. The best SPY ETF. I see. Yeah. So SPY ETF. Well, SPY is an ETF, but I know you mean S&P 500 ETF. There are lots out there. You can utilize a screener to find them, but what's important is liquidity. So if you're looking purely for the security, there are various ones out there. Just look at the expense ratio. That's something you want to look at, and also the tracking error. So those are two figures that I would look at when I'm trying to choose an exchange traded fund. Tracking error means, is it actually doing exactly as the benchmark index that it's supposed to mirror? And if that's really high and something else is rather low, then you probably should choose that one. And then also look at volume. If you're looking at an exchange traded fund, you want to make sure that there's more volume there, because then you're able to trade it, especially if you're looking at options. Some options, you don't have a lot of volume, and that's important when selecting an ETF, especially if you're going to implement this type of strategy. There is one on the wash sale rule applying when you roll up. So that the wash sale rule does apply to options with the same exact option. So if you're rolling up, that's a different option, different strike. So same strike, same expiration, wash sale rule will apply. Some of these questions are very first trade specific, so I'm going to leave those, and they'll be follow up. More basic webinar. There's a options pricing webinar that we put on YouTube, and we can definitely do this with First Trade as well. But if you go to Options Plays YouTube channel, you can find that there, and there's a lot more basic webinars out there. All right. Explain how a roll covered works and a call option and put option. All right. Rolling is, it's just entering a trade at one time, and that has its advantages and disadvantages. So exchanges accept trades in various forms. Most actually, the variety of exchanges, the vast majority, single-legged transactions. So what that means is if you are buying to close your short option, just like that, you're more likely to get an execution because it's going to a variety of exchanges. If you submit it as a roll, which means buy to close and sell to open the same time, and that's normally for a credit, you are limiting the exchanges that accept that order, which means less likelihood of execution. Depending on the price, they all have likelihood of execution, but that's something important to know as far as submitting them. But all a roll simply is when you have your short call, you're buying to close, and at the same time entering an order of selling to open. And you can also do that as two separate orders. You don't have to do it at one time. Ta-da. Selling covered calls on penny stocks. So that question I am going to take. So Penny stocks normally don't have optionable securities, so that's something important. There are listing requirements for, in order to have an underlying security, have options. One of those is a minimum float, and also price. I believe it's $10 per share. I'm gonna, don't quote me on that one, but you can look it up on OCC.com. But there are requirements for a underlying security to be listed, and penny stocks do not meet those requirements, so you won't be able to trade options on penny stocks. But you can look for lower price securities, absolutely, but not penny stocks. All right. Why is it not advisable to trade low liquidity stock options for income? Well, that's because you can't necessarily get out of them. So whenever you have little volume in an option, the spreads will be very wide. And if the spreads are very wide, you're not going to get a good price. And that's very important trading period. So that's something you want to look out for whenever you're trading options specifically, is the price is very, and that's what that options pricing webinar goes over, is very logical. It has three components, which is time, intrinsic value or actual and the money value, and implied volatility. All of that is really taken out of the equation if it doesn't have any liquidity, because remember, if someone else has to buy the other side of that contract, and that someone else may be a market maker, and he may not want to do that simply because a lack of liquidity. And so therefore you won't have an optimal price. And that's where you could end up getting taken advantage of, to be honest. Okay. Alrighty. All right, so I see the questions dying down. Give it about another 30 seconds for one more. Okay. Well, I sincerely appreciate everyone joining today's session. Thank you so much. I hope you learned something. And I hope you have a wonderful day. Thank you, everyone.